The U.S. stock market on July 15, 2025, closed with gentle movements, but no less noteworthy, reflecting a period fraught with pressure on investor sentiment, while also containing prominent highlights from technology pillars. Facing the electronic board, the numbers fluctuating within a narrow range became the focus of in-depth analyses on macroeconomics, monetary policy, and market confidence. At the end of the trading session, the SPDR S&P 500 ETF Trust SPY index closed at $623.35, down slightly by $1.46, equivalent to 0.23% compared to the previous session. Although a modest figure, this adjustment carries significant meaning as it occurred while SPY was hovering near its highest peak of the year at $626.87. During the session, SPY reached $627.90, hitting a new record high, before retreating to a low of $623.00 prior to closing. Since the beginning of the year, SPY has surged strongly, rising from a low of $480.80 to the current high, demonstrating considerable momentum and accumulated investor confidence throughout the first half of 2025. However, behind that stability sits an undercurrent of concerns about inflation and the monetary policies of the U.S. Federal Reserve, Fed. The latest macroeconomic data shows that inflation in June rose to 2.7%, and the core CPI, which excludes food and energy prices, also surged to 2.9%. This is the sharpest increase in many months, mainly due to the impact of new tariff measures and rising import costs. Prices of essential goods such as food, clothing, and electronic devices all increased simultaneously, pushing up the cost of living for Americans. This not only stifles consumption but also erodes confidence, adding pressure on policymakers. In that context, the Fed decided to keep interest rates unchanged in the range of 4.25%–4.5%. This move somewhat reflects the caution of the Monetary Authority amid inflation showing no clear signs of easing. Investors had hoped that the Fed would soon ease its policy, but the current reality has made confidence in the possibility of rate cuts in 2025 fragile. In particular, the Fed is also facing increasing political pressure. Calls to replace Chairman Jerome Powell, along with criticisms about the cost of renovating the Fed headquarters, have raised concerns about the independence of the world's most powerful central bank. When monetary policy risks being influenced by political motives, market volatility becomes even more unpredictable. The impact of inflation and interest rates not only stops at the stock market, but also spreads to the bond market. The yield on the 10-year U.S. Treasury bond surged to 4.47% during the day, the highest level in 3 months. This reflects concerns about prolonged inflation and investors' caution over the possibility that the Fed will continue to maintain or even raise interest rates if price developments remain unfavorable. When bond yields rise, stocks, especially high-growth and highly valued stocks, will face direct competitive pressure. Capital may shift to safer investment channels, while businesses have to bear higher borrowing costs. However, amid concerns about inflation, interest rates, and policy uncertainty, the market still witnessed bright spots from the technology stock group, exemplified by Nvidia. In today's session, Nvidia's stock continued to surge strongly, rising by up to 4.4%, thanks to information that the U.S. government has assured it will continue to grant chip export licenses. This good news has helped technology stocks in general, and Nvidia in particular, serve as a solid support, pulling the Nasdaq index up and thereby easing the heat from selling pressure in other sectors. Nvidia's story is not just the story of a single company, but a testament to the vigorous vitality of the technology sector in the modern economic landscape. Despite facing global macroeconomic risks, leading corporations like Nvidia have maintained their growth momentum thanks to their innovation capabilities, application of artificial intelligence, and effective response to global digital transformation demands. This differentiation shows that the U.S. stock market no longer moves in unison as before, but now exhibits clear choices between industry groups, between winners and losers in the era of technologization. Looking back at the overall market, the Dow Jones index also fell slightly by about 0.2% today, reflecting pressure on large-cap stocks in traditional sectors such as finance, consumer goods, and industry. Meanwhile, the Nasdaq index, supported by the momentum from technology stocks, especially Nvidia, managed to stay in the green. This divergence in trends further highlights the pivotal role of technology companies in supporting the overall index, while also serving as a warning about the sustainability of the rally when the market relies on just a few leaders rather than broad-based participation. In addition, investor sentiment is also significantly affected by political fluctuations related to the Fed. When messages about the possibility of replacing Chairman Jerome Powell appear, the market immediately reacts with increased caution. Many investors worry that if the Fed loses its independence, monetary policy decisions will be influenced by short-term goals rather than aiming for long-term stability of the economy. This leads to increased expectations for long-term interest rates, while reducing the attractiveness of risk assets such as stocks. To gain a deeper understanding of the relationship between monetary policy and today's market developments, the main factors can be summarized as follows. Firstly, high inflation pressure reduces expectations that the Fed will cut interest rates soon. This causes borrowing costs for businesses and individuals to remain high, creating a burden on corporate profits, which directly affects stock prices. Secondly, concerns about the independence of the Fed increase market volatility. When monetary policy risks being influenced by political motives, investors act more cautiously, limiting disbursements into risky assets while increasing demand for safe assets such as bonds or gold. Thirdly, the sharp rise in bond yields has put significant competitive pressure on stocks, especially high-valued stocks. However, on the other hand, the financial sector may benefit from the widening interest margin, while leading technology companies continue to maintain their appeal due to long-term growth prospects. Finally, the leading role of major names like Nvidia continues to affirm the importance of technology in the structure of the modern market. At a time when traditional industries are struggling, it is the technology companies with their ability to innovate and lead trends in artificial intelligence, cloud computing, autonomous vehicles, and more that serve as a support to prevent the market from falling into a deep correction. The differentiation between industry groups also implies investment strategies during this period. Investors need to carefully consider holding high-growth stocks, which are sensitive to interest rate fluctuations, and defensive stocks or financial groups, which are expected to benefit if interest rates remain high. Additionally, closely monitoring signals from the Fed regarding monetary policy direction, as well as actual inflation developments, will be key to making reasonable investment decisions. Looking further ahead, the U.S. financial market is entering a sensitive phase, where every statistic, every statement from Fed leaders, or even political moves can create undercurrents that affect investor sentiment and investment trends. Investors not only monitor price boards, but also continuously update macroeconomic factors, policies, and thoroughly analyze possible scenarios. If inflation continues to remain high, the Fed may be forced to keep interest rates elevated longer than expected, and even consider further increases if price indices get out of control. In that case, the stock market will face more pronounced adjustment pressure, especially for groups of stocks with high valuations based on growth expectations. Conversely, if inflation shows signs of cooling down, the Fed signals it will ease policy, and capital may strongly return to stocks, creating a new wave of market gains. However, whichever scenario occurs will largely depend on external factors such as the global trade situation, geopolitical developments, as well as fiscal policies from the U.S. government. New tariff measures, increased import costs, or trade protectionist policies will continue to be unpredictable variables directly affecting inflation and the economic growth of the United States. In that context, investors need to remain alert, flexible, and ready to adapt to unexpected fluctuations. Building a balanced portfolio across sectors, combining growth stocks, defensive stocks, and safe assets such as bonds, will help minimize risks and optimize long-term returns. In summary, the trading session on July 15, 2025 ended with signs of a slight adjustment, but raised many major questions about the market outlook in the near future. Pressure from inflation, the Fed's cautious monetary policy, the divergence between industry groups, and political uncertainties related to the central bank will continue to be hot topics, influencing the sentiment and actions of global investors. Amid this wave of volatility, only those who persistently monitor, thoroughly analyze, and know how to take advantage of opportunities arising from industry divergence can achieve sustainable success in the U.S. stock market.